There is a number, a single figure released every 3 months, that holds the power to create and destroy fortunes in an instant. It flashes across news tickers, it's whispered with reverence or panic in boardrooms, and it dictates the daily rhythm of Wall Street. This number is called earnings per share, or EPS. We have been conditioned, through decades of financial media and market tradition, to see this number as the ultimate measure of a company's success. When it goes up, we feel a surge of confidence. When it goes down, we feel the cold grip of fear. We have been taught that our entire project of wealth creation, of achieving financial freedom, hinges on the quarterly pronouncements of this single, tidy figure. And this conditioning is based on a profound and deeply misleading lie. The truth is, the reported earnings per share number is not what your investment is actually earning for you. It is a fraction of the story, a carefully curated snapshot designed for public consumption, but it is not the truth of your ownership. Warren Buffett, the most successful investor in history, understood this deception early in his career. He realized that the 99% of investors who fixate on this number are like spectators in a grand theater, watching the actors on stage, while he had found a secret door that led him backstage, where he could see the entire production, the machinery, the finances, the true, unvarnished reality of the business. He developed a private calculation, a different way of seeing, that allowed him to perceive the hidden profits, the silent rivers of cash that companies were reinvesting on behalf of their real owners. This concept is called look-through earnings, and it is the intellectual key that unlocks the door between being a mere stock trader and becoming a true business owner. To understand look-through earnings is to fundamentally change your relationship with your investments. It is to stop being a passive recipient of whatever the market decides to give you, and to start seeing yourself as a silent partner in some of the greatest businesses in the world. You will learn to calculate your real share of a company's total earnings, not just the pittance they might send you as a dividend, but the entire sum of wealth created in your name. This will give you a profoundly more accurate picture of your investment's growing value. It will empower you to identify the powerful compounding machines, the quiet wealth creators that the market, in its obsession with the noisy spectacle of quarterly earnings, so often misprices. This is not a simple tip or a trick. This is a fundamental shift in perspective, a piece of advanced investing knowledge that forms the bedrock of a multi-billion-dollar fortune. It is the secret that separates the speculator from the proprietor. The journey we are about to embark on will deconstruct the illusion of reported profit and replace it with the powerful reality of economic ownership. It is the final promise that value investing makes, to see what is true, not just what is shown. Our first step in this journey of investor education requires us to dismantle the very foundation of modern financial reporting, the sanctity of the earnings per share number. We must understand why this figure, so widely worshipped, is often a dangerous illusion. To do this, we must travel back in time, not to a story of a spectacular success, but to one of Warren Buffett's most formative and painful failures. The story of Berkshire Hathaway, the textile mill. In the early 1960s, long before Berkshire Hathaway became the global conglomerate it is today, it was a struggling textile manufacturer in New Bedford, Massachusetts. Buffett began buying its stock in 1962. At the time, he was still a devout disciple of his mentor, Benjamin Graham, the father of value investing. Graham's method was quantitative, focused on buying so-called cigar butts, companies that were trading for less than their net current asset value. On paper, Berkshire Hathaway was a perfect Graham stock. Its stock price was so low that it was trading for a fraction of its working capital. The logic was simple. The assets, the machinery, the inventory were worth more than the entire company's market valuation. The reported earnings weren't great, but they were positive. It seemed like a classic no-lose situation. Buffett bought a controlling interest, eventually taking over the company entirely. He thought he could turn it around. He was wrong. What he discovered was a brutal business reality that no balance sheet could fully capture. The American textile industry was in a terminal decline, facing relentless, low-cost competition from overseas. The company would report a profit, a small but respectable number for its earnings per share. But here was the insidious trap. To generate that small profit, the company had to constantly spend enormous sums of money just to stay in the game. The looms were old. They had to be replaced with newer, more efficient models, not to expand the business, but simply to keep up with competitors. Every dollar of reported profit, and then some, was immediately consumed by capital expenditures. He later described it with a poignant metaphor. The business was like a horse and buggy company trying to compete with the advent of the automobile. You could work hard, you could have the best buggy whip maker in the world, you could even show a small profit each year, but the fundamental economics were moving against you. The reported earnings per share number was a mirage. It suggested profitability, but it hid the fact that the business was a capital-intensive nightmare. The cash generated was not free to be distributed to owners or invested in new, promising ventures. It was chained to the maintenance of a dying enterprise. For nearly 2 decades, Buffett struggled with the textile business. He poured capital into it, trying to make it work. He was fighting against an unstoppable economic tide. This experience, this long, grinding battle with a business that was profitable on paper but a black hole for cash in reality, seared a crucial lesson into his mind. Reported profit is not the same as owner profit. A business can report earnings while simultaneously destroying the long-term value of its owner's capital. He learned, through the loss of millions of dollars and years of effort, that the most important question is not how much did the company report in earnings, but rather what happened to the money the business earned. Was it a real, spendable surplus? Or was it phantom profit, an accounting fiction that vanished into the hungry jaws of maintenance and survival? This painful lesson with the original Berkshire Hathaway textile operation became the crucible in which his later, more sophisticated philosophy was forged. He moved away from Graham's cigar butt approach and started looking for wonderful businesses with durable competitive advantages, businesses that gushed cash rather than consuming it. He learned that the quality of the earnings was infinitely more important than the quantity. And it all began with the realization that the earnings per share number, that holy grail of Wall Street, could be the most dangerous lie in all of finance. The reason so many intelligent people are consistently fooled by the illusion of reported earnings lies deep within the wiring of the human brain. Our minds are pattern recognition machines, but to cope with a complex world, they rely on shortcuts, on mental heuristics. And these shortcuts, while often useful, can lead to massive and systematic errors in judgment, particularly in the world of finance. The two most powerful cognitive biases at play here are the anchoring bias and the availability heuristic. Let's start with the availability heuristic. This principle states that our brains tend to judge the importance and frequency of an event by how easily it comes to mind. Things that are recent, vivid, or frequently repeated seem more significant than they actually are. Now think about the earnings per share number. It is the single most available piece of financial data in the world. Every quarter, it is the headline. Company X beats earnings estimates. Company Y misses expectations. It's blasted across CNBC, it's the lead in the Wall Street Journal, it's the first number you see on Yahoo Finance. It is simple, it is singular, and it is everywhere. Because it is so readily available, our brains assign it an enormous, disproportionate weight in our decision-making process. We don't have to dig through a dense 100-page annual report to find cash flow statements or analyze the return on invested capital. We are handed the EPS number on a silver platter, and so we use it. We judge a company's entire quarterly performance, its health, its future, based on this one easily retrieved data point. The second cognitive trap, the anchoring bias, then locks this error in place. Anchoring refers to our tendency to rely too heavily on the first piece of information offered when making decisions. That first piece of information becomes an anchor that influences all subsequent judgments. When you look up a stock, the first valuation metric you often see is the price-to-earnings ratio, the PE ratio, which is based directly on the reported EPS. That PE ratio becomes your anchor. You start to think, a PE of 15 is cheap, or a PE of 40 is expensive. Your entire framework for stock valuation is now anchored to that potentially flawed earnings number. You might then read further. You might even look at the cash flow, but you will be subconsciously trying to reconcile that new information with your initial anchor. If the cash flow is poor but the EPS was good, you might rationalize it, well, it's just a temporary issue, the earnings are what really matter. The anchor pulls your judgment back towards the initial easy number. Buffett's genius was in recognizing this flaw in his own thinking and in the market's collective mind. He consciously chose to discard the easy anchor. He forces himself to ignore the readily available EPS figure and instead do the hard work of reading the full financial statements. He's looking for a different anchor, the true underlying economic reality of the business. By focusing on owner earnings and the concept of look-through earnings, he is creating a new, more reliable anchor for his valuation. He is deliberately making the invisible visible. He is fighting the availability heuristic by giving more weight to the data that is harder to find but infinitely more important. This is a profound act of intellectual discipline. It's about understanding that your brain is wired to take the easy path, to grab the convenient number. The entire edifice of short-term market speculation is built on exploiting these cognitive biases. The quarterly earnings game is a grand spectacle designed to trigger our availability heuristic and our anchoring bias, creating volatility that short-term traders can exploit. By learning to see past the EPS number, you are not just learning a new financial metric, you are engaging in an act of rebellion against your own flawed mental wiring. You are training yourself to be a deep thinker in a world of shallow reactions. So how do we begin this rebellion? How do we translate this psychological insight into a practical, repeatable process? We need a mental model, a blueprint that allows us to systematically question the official story told by reported earnings. We can call this model the earnings quality audit. It's a 5-step process that anyone can use to look behind the curtain of the income statement and assess whether the reported profits are real or merely an accounting mirage. Step 1 is to accept the reported EPS number, but only as a starting point. Find it, write it down, but treat it with suspicion. It is not the answer. It is the beginning of your investigation. Step 2 is to immediately leave the income statement and go to the consolidated statement of cash flows. This is arguably the most important of the 3 main financial statements because it is the hardest to manipulate with accounting tricks. Cash is either in the bank or it isn't. On this statement, you are looking for one key line item: cash flow from operations. Now you compare this number to the net income figure from the income statement. In a healthy, high-quality business, cash flow from operations should be roughly equal to, or ideally, greater than net income over time. If a company consistently reports high net income but its cash flow from operations is weak or negative, that is a massive red flag. It means the company is booking profits that aren't showing up as actual cash. This can happen for many reasons, such as aggressive revenue recognition or a buildup of unsold inventory, but it almost always signals a low quality of earnings. Step 3 of your audit is to become a detective of one-time events. Go back to the income statement and the management's discussion and analysis section of the annual report. You are hunting for anything that might have artificially inflated the reported net income for that period. Did the company sell a factory or a piece of real estate? That will show up as a gain on sale, boosting EPS, but it has nothing to do with the core recurring profitability of the business. Was there a large one-time tax benefit? Or a favorable legal settlement? These are not repeatable sources of income. A high-quality business generates its earnings from its primary operations, year in and year out. You must learn to mentally subtract these one-time gains to see the true, underlying earning power. Step 4 is to investigate the company's revenue recognition policies. This is a bit more advanced, but it's crucial. In the notes to the financial statements, the company must describe how it recognizes revenue. Are they booking revenue as soon as a contract is signed, even before the work is done or the cash is collected? Are they using aggressive financing deals to pull future sales into the current quarter? This is where a lot of accounting games are played to make the quarter and hit those EPS targets that Wall Street is so anchored on. A conservative, high-quality company will have clear and straightforward revenue recognition policies. Step 5. Your final check in the earnings quality audit is to look for changes in accounting assumptions. Companies have some leeway in how they account for things like inventory, LIFO versus FIFO, or depreciation. If you notice in the footnotes that a company has suddenly changed an accounting assumption, and this change had a material positive impact on reported earnings, you should be extremely skeptical. Often, this is a sign that management is trying to paper over weakness in the core business by pulling an accounting lever. By following these 5 steps, comparing income to cash flow, hunting for one-time events, investigating revenue recognition, and checking for changes in assumptions, you are no longer a passive consumer of financial news. You are an active critical analyst. You are performing the fundamental analysis required to protect yourself from the grand illusion. This audit process is the necessary groundwork. It cleans the slate. It teaches you to distrust the easy answer and prepares your mind for the next, more powerful step, replacing the flawed EPS number with the truth of look-through earnings. To truly appreciate the power of this new perspective, we must first understand the path of the 99%, the mindset that Buffett's approach is designed to overcome. This is the path of the EPS chaser. The EPS chaser lives and dies by the quarterly earnings report. Their entire investment strategy is a reactive cycle of anticipation, reaction, and repetition. Let's paint a picture of this individual. A few weeks before earnings season, the anxiety begins. They are checking analyst estimates, reading news articles about whisper numbers, the unofficial earnings targets that circulate among traders. Their focus is not on the long-term health of the business, its competitive position, or its return on capital. Their entire focus is on a single data point. Will the company's reported EPS for the next 90 days be a penny higher or a penny lower than a group of analysts predict? The day of the earnings release is their Super Bowl. They watch the clock, waiting for the press release to hit the wire after the market closes. The number comes out. Let's say the company reported $1.10 in EPS, while the consensus estimate was for $1.08. A beat. The EPS chaser feels a rush of validation. In after-hours trading, the stock price jumps 5%. The next morning, they log into their brokerage account, perhaps buy more shares. Feeling like a genius, they are part of the winning team. They have successfully predicted a number. They don't dig any deeper. They don't perform an earnings quality audit. They have no idea that this "great" earnings beat was entirely due to the company selling a subsidiary, a one-time event that has no bearing on future profitability. They don't see that the company's core operations actually lost money, and that cash flow was deeply negative. They don't understand that the company is taking on debt to fund its operations. They see the positive EPS number, the green arrow on their screen, and their brain's reward centers light up. Now consider the alternative scenario. The company reports $1.06, missing the estimate by 2 cents. A miss. Panic sets in. The stock plummets 10% in after-hours trading. The EPS chaser, feeling the sting of loss and fear, sells their shares the next morning, vowing never to trust that company again. They don't know that the reason for the miss was a massive one-time investment in a new research and development facility that will secure the company's competitive advantage for the next decade. They don't realize that the company is sacrificing a few pennies of reported profit today for dollars of real economic value tomorrow. The EPS chaser is a puppet, and the strings are being pulled by the quarterly earnings cycle and the Wall Street analysts who perpetuate it. They are perpetually focused on the scoreboard, not the game. They celebrate a meaningless victory or mourn a misunderstood defeat. Their portfolio growth is dictated by randomness and short-term sentiment. This approach is the antithesis of long-term investing. It is a recipe for buying high and selling low, for churning your account, and for enriching your broker. It is a complete abdication of the responsibilities of ownership. By chasing the phantom of reported earnings, this investor never gets to experience the profound wealth-creating power of owning a piece of a truly great business. They are stuck on the surface, reacting to shadows, while the real substance of value creation happens in the depths they refuse to explore. The financial consequences of this difference in perspective between the EPS chaser and the disciplined analyst are not theoretical. They manifest directly and powerfully on a company's financial statements and, ultimately, in your brokerage account. Let's illustrate this with a direct comparison of two hypothetical companies, Company A, Acme Illusions, and Company B, Bedrock Builders. Both companies operate in the same industry and, for the past year, both reported the exact same headline earnings per share, $5. The EPS chaser looks at these two companies and sees them as equals. They might even prefer Acme Illusions if it has a slightly more exciting story. But now we will apply our earnings quality audit and see how their financial realities diverge. We start with Acme Illusions. We look at its income statement and see net income of $100 million with 20 million shares outstanding, giving us the $5 EPS. But then we perform step 2 of our audit and go to the cash flow statement. We find that cash flow from operations was negative $50 million. The company reported a massive profit but actually burned through cash. How is this possible? We move to step 3, the search for one-time events. In the footnotes, we discover that Acme sold off its most profitable division for a one-time gain of $150 million. Without this asset sale, the company would have reported a massive loss. The headline EPS number was not just an illusion, it was a deliberate act of financial misdirection. The balance sheet confirms this story of decay. Acme's cash balance has dwindled, its debt has increased, and its base of productive assets has shrunk because it sold a key division. The company is financially weaker at the end of the year than it was at the beginning, despite its stellar reported earnings. Now let's turn to Bedrock Builders. It also reported $5 EPS from $100 million in net income. But when we look at its cash flow statement, we see cash flow from operations of $120 million. The profits are real. They are backed by an even greater amount of cold, hard cash. We perform step 3 and find no significant one-time events. The profit was generated from the company's core business of building and selling quality products. What did Bedrock do with that cash? The financial statements show that it paid down debt, it invested in upgrading its factories to become more efficient, and it bought back 5% of its own shares. The balance sheet of Bedrock Builders tells a story of increasing strength. Its cash is up, its debt is down, its asset base is more productive. And because there are fewer shares outstanding, each remaining share, including yours, now represents a larger slice of this stronger, more profitable enterprise. Over the course of 1 year, the EPS chaser sees these two companies as identical, but the investor who understands earnings quality sees a stark difference. Acme Illusions is a melting ice cube, selling its furniture to heat the house for one night. Bedrock Builders is a fortress, using its profits to reinforce its walls and expand its domain. The financial connection is direct and brutal. An investment in Acme Illusions, despite its impressive reported EPS, is an investment in a deteriorating business. Its stock price is built on a foundation of sand, destined to collapse when the one-time gains run out. An investment in Bedrock Builders is an investment in a genuine value-creating machine. Its growth in intrinsic value is real and sustainable. This is the tangible, quantifiable difference between chasing accounting profits and investing based on economic reality. It is the difference between speculation and sound financial analysis. Having cleared away the rubble of the EPS illusion, we can now begin to construct a more powerful and truthful framework. This brings us to the core principle of our discussion, the birth of the look-through philosophy in the mind of Warren Buffett. This was not an overnight discovery, but an evolution, a gradual shift from the quantitative, asset-based approach of his mentor, Ben Graham, to a qualitative, earnings power-based approach that was uniquely his own. A pivotal moment in this evolution was the great salad oil scandal of 1963. The story involves a company called American Express. At the time, American Express had a division that issued warehouse receipts. A company could store its goods in an American Express warehouse and get a receipt that it could then use as collateral for loans. One of its clients was the Allied Crude Vegetable Oil Company. The problem was, Allied was a complete fraud. They filled their giant storage tanks mostly with water, with only a thin layer of soybean oil on top. When inspectors checked the tanks, they saw oil. Allied used these fraudulent warehouse receipts to secure massive loans. When the fraud was discovered, Allied went bankrupt, and the banks who held the worthless receipts came to American Express demanding to be made whole. Wall Street panicked. The potential liabilities for American Express were enormous, possibly exceeding the entire net worth of the company. The stock price was obliterated, falling by nearly 50%. The consensus was that the company was doomed. The headlines were screaming about the scandal, and the upcoming earnings reports were guaranteed to be horrific, filled with massive write-offs and losses. This is where the 99%, the EPS chasers, ran for the exits. They saw a future of negative earnings and sold in a panic. But Warren Buffett saw something different. He didn't just look at the headlines or the impending earnings disaster. He applied a look-through mindset to the business itself. He asked a simple question: has this scandal permanently damaged the real, underlying economic engines of American Express? To answer this, he didn't just read financial reports. He did what he famously calls scuttlebutt. He went to banks, to restaurants, to travel agencies. He talked to people. He would ask bankers if they were still using American Express travelers' checks. They were. He would ask merchants if they were still accepting the American Express card. They were. He observed customers in restaurants and saw them pulling out their green American Express cards and travelers' checks, just as they always had. He discovered that the scandal, while a massive financial blow to one division, had not touched the core of the business. The brand, the trust that customers had in the traveler's checks and the credit card, was intact. The fundamental earning power of the company's two main businesses was completely unharmed. He looked through the temporary, spectacular loss that would dominate the upcoming earnings reports and saw the durable, long-term profitability that lay beneath. He concluded that the market, in its panic over the reported numbers, was offering him the chance to buy a piece of a wonderful business at a ridiculously cheap price. He invested 40% of his partnership's capital into American Express stock. It became one of his most successful investments, a home run that helped build the foundation of his fortune. This story is the perfect embodiment of the look-through philosophy. It is the discipline of separating a temporary business problem from a permanent one, of distinguishing an accounting event from an economic one. It is about ignoring the loud, screaming noise of the present to focus on the quiet, persistent signal of long-term value. He did the same thing with See's Candies years later, paying a price that was 3 times its book value, an act that would have been heresy to a strict Grahamite, because he looked through the reported assets on the balance sheet and saw a priceless, unreported asset, a beloved brand that commanded customer loyalty and allowed the business to generate huge amounts of cash with very little capital investment. The birth of this philosophy was a shift from seeing a stock as a piece of paper with numbers attached to seeing it as a fractional ownership of a living, breathing business. It was the realization that the true measure of an investment's success is not its quarterly reported EPS, but its long-term, underlying, look-through earning power. The market's obsession with reported earnings creates a powerful psychological trap known as the framing effect. This cognitive bias demonstrates that people decide on options based on whether the options are presented with positive or negative connotations, for example, as a loss or as a gain. How information is framed can dramatically alter our perceptions and decisions, even if the underlying facts are identical. Wall Street is a master of framing. It frames a company's performance almost exclusively through the narrow, short-term lens of the quarterly earnings report. The entire narrative is structured around beats and misses. A company that reinvests heavily for the future, thus depressing its current reported earnings, is framed as a miss, a failure. A company that slashes research and development to make its quarterly number is framed as a beat, a success. This framing forces investors into a specific and deeply flawed mental model. This is compounded by another powerful bias, mental accounting. Coined by Nobel laureate Richard Thaler, mental accounting is the tendency to divide our money into separate, non-transferable accounts based on subjective criteria, like the source of the money or its intended use. In investing, we do this all the time. Investors create a mental account for dividends received and another, completely separate one for, quote, capital gains. The money in the dividend account feels real, tangible. It's cash that hits our brokerage account. We can spend it or reinvest it. It feels like our true return. The retained earnings of a company, the profits that are not paid out as dividends but are reinvested back into the business, go into a vague, undefined mental account that most investors simply ignore. They don't feel it, they don't see it, it doesn't seem like their money. Buffett's look-through earnings philosophy is a powerful psychological tool designed to break both of these biases. It completely reframes the question of profitability. Instead of asking, "What was the reported EPS?" it asks, "As a part owner of this business, what was my share of the total profit, and what did the managers I hired do with my money?" This reframing shatters the artificial wall of mental accounting. It forces you to see that there is no difference between a dollar paid to you as a dividend and a dollar retained by the company to be reinvested on your behalf. Both dollars belong to you. They are both your profit. The only relevant question is where that dollar can be put to its highest and best use. If you, as an individual, can reinvest that dollar after paying taxes on it and earn a 6% return, but the company can keep that dollar, pay no immediate corporate tax on it, and reinvest it in a project that will earn a 20% return, then that retained dollar is far more valuable to you than the dollar paid out as a dividend. Look-through earnings forces you to combine your mental accounts. The dividend you receive and the earnings the company retains are not two different things. They are two allocations of the same thing, your profit. This is a profound mental shift. It moves you from the mindset of a passive stock picker, hoping for a dividend check, to the mindset of a proprietor, a capital allocator. You are no longer just a spectator being told a framed story by Wall Street. You are an owner, looking at the full, unframed reality of your business's operations. You stop asking, "Did the company beat expectations?" and start asking, "Did my CEO make intelligent capital allocation decisions with my share of the earnings?" This change in perspective is the key to weathering market volatility, to holding on to great businesses for the long term, and to unlocking the true power of compounding. It is an act of declaring your intellectual independence from the market's flawed psychological frames. To make this mental shift concrete, we need a simple yet powerful applied mental model. Let's call it the business owner's ledger. This isn't a complex spreadsheet. It's a way of thinking, a story you tell yourself to internalize the look-through concept. I want you to imagine for a moment that you don't own a few shares of a public company. Instead, imagine you are the sole owner of a successful local business, a popular coffee shop. At the end of the year, you sit down with your accountant, and she tells you that after all expenses, the coffee shop generated a profit, a net income of $100,000. Now, as the sole owner, you have a decision to make. What do you do with this $100,000? It is all your money. You could take the entire $100,000 out of the business and put it in your personal bank account. This is the equivalent of a public company paying out 100% of its earnings as dividends. But you're a smart business owner. You see an opportunity. There's a new office building opening up a few blocks away, and you think a small espresso kiosk there could be incredibly profitable. You decide to take only $20,000 as a personal salary for the year. This is your dividend. It's the cash you receive directly. With the remaining $80,000, you decide to reinvest it back into the business. You buy a new, high-end espresso machine, and you pay for the construction and launch of the new kiosk. This $80,000 is your retained earnings. Now, at the end of the year, I ask you a simple question. How much money did you make? Did you make $20,000, the amount that hit your personal bank account? Or did you make $100,000? The answer is obvious. You made $100,000. You simply chose to take part of your profit in cash, and the other part in the form of an expanded, more valuable business that will likely make you even more money next year. The $80,000 you reinvested is still your money, it's just working for you inside the company. This is the business owner's ledger. It is the fundamental logic of look-through earnings. Now let's apply this to a publicly traded stock. You own 100 shares of a company. You go to their annual report and find that the company's total net income for the year was $10 billion. You also find that there are 1 billion shares outstanding. A simple calculation, $10 billion per 1 billion shares, tells you that the company earned $10 for every share. This is the company's EPS. Since you own 100 shares, your share of the total profit is 100 times $10, which is $1,000. This $1,000 is your look-through earning. It is the entry in your business owner's ledger. Now, you look at the dividend information. The company paid a dividend of $2 per share, so you received 100 times $2, which is $200 in cash in your brokerage account. This is your personal salary from your business. The remaining amount, your $1,000 of profit, minus the $200 you received in cash, is $800. This $800 is the money the company's management, acting as your employees, retained and reinvested on your behalf to grow the business. Your real profit for the year was not the $200 that showed up in your account. It was $1,000. By consistently applying this business owner's ledger model to every stock you own, you will transform your understanding of your portfolio. You will start to see the retained earnings not as some abstract corporate figure, but as your own capital, being deployed by a management team you have implicitly hired. This immediately leads to the next crucial question. Are they deploying it well? But for now, mastering this first step, seeing your full, true profit, is the essential foundation for becoming a genuine long-term investor. The path of the 99% in this context is to be the dividend chaser. This investor operates under a mindset that is the polar opposite of the business owner's ledger. The dividend chaser has a very specific and limited view of what constitutes a return on their investment. Cold, hard cash deposited in their brokerage account. Their mental accounting is rigid. Only dividends are real profits. Capital gains are a speculative bonus, and retained earnings are an invisible abstraction that might as well not exist. The dividend chaser's process for stock selection is dangerously simple. They screen for stocks with the highest dividend yields. A company paying a 5% dividend is, in their eyes, inherently superior to a company paying a 1% dividend or no dividend at all. They see this high yield as a mark of safety and shareholder friendliness. They believe they are being paid to wait, collecting a reliable income stream. But this focus is a form of financial myopia. They are so fixated on the small portion of earnings being distributed that they are completely blind to the larger portion of earnings being retained, and more importantly, what is being done with them. Let's consider a classic value trap that the dividend chaser consistently falls into. They find a company, perhaps an older, struggling industrial firm, that has a dividend yield of 8%. This looks incredibly attractive compared to the overall market yield of 2%. They buy the stock, congratulating themselves on securing such a high guaranteed income. What they fail to investigate is the sustainability of that dividend. They don't look at the cash flow statement. If they did, they might discover that the company's earnings and cash flows have been declining for years. They might see that the company is only able to pay that generous dividend by taking on more debt or by selling off assets. The dividend is not being paid out of current profits. It's a liquidation payment, a return of capital disguised as a return on capital. The company is slowly cannibalizing itself to maintain the illusion of a high yield, and the dividend chaser is happily holding the plate. Even more perniciously, the dividend chaser will instinctively reject some of the greatest wealth-creating companies of our time. They would look at a dynamic, innovative company that is growing at 25% per year and say, "No thanks, it doesn't pay a dividend." They cannot comprehend that this company is retaining 100% of its massive profits and reinvesting them into projects with incredibly high rates of return. Every dollar the company retains is creating $2 or $3 of future value. The dividend chaser, by demanding their dollar back today in the form of a dividend on which they have to pay taxes, is choosing a small, immediate gratification over an exponentially larger future fortune. They are like a farmer who eats his seed corn. They are so focused on the small fruit they can pick today that they fail to see the enormous, thriving orchard being planted with the retained earnings. This mindset leads to a portfolio of slow-growing or even decaying businesses. It prioritizes a small, taxable, immediate cash flow over massive, tax-deferred, long-term capital appreciation. The dividend chaser feels safe because they are getting their checks, but they are often taking on far more risk than they realize. The risk of permanent capital impairment in decaying businesses and the even greater opportunity cost of missing out on the world's great compounders. It is a path of perceived safety that leads to guaranteed mediocrity. Let's quantify the enormous financial consequences of these two opposing philosophies: the dividend chaser versus the look-through owner. We'll project the outcomes of two investments over a 10-year period. Let's assume you have $10,000 to invest. Your choice is between two companies, Steady Payout Inc. and Growth Compounders Corp. Investment A is Steady Payout Inc. It's a mature utility company. It earns $10 per share each year. Being a mature business, it doesn't have many opportunities for high-growth reinvestment. So it has a policy of paying out 80% of its earnings as dividends. This means it pays a dividend of $8 per share. The remaining $2 per share are its retained earnings, which it reinvests back into its business at a modest but stable 6% rate of return. The dividend chaser loves this stock. That $8 dividend on a hypothetical $100 stock price is an 8% yield. It feels fantastic. Investment B is Growth Compounders Corp. It's a leader in a growing industry. It also earns $10 per share this year. However, its management has identified numerous high-growth opportunities. They decide to pay no dividend. They have a 0% payout ratio. 100% of the earnings, the full $10 per share, are retained and reinvested. And because of their competitive advantages, they can reinvest this capital at a very high rate of return, say 20%. The dividend chaser would never even consider this stock. Now, let's track the financial connection to your portfolio over the next decade. For simplicity, we'll assume the stock prices perfectly track the growth in their underlying earning power. In year 1, with Steady Payout Inc., you receive your dividends. Let's say you reinvest them back into the stock. The company's earning power grows very slowly, only by the 6% return it gets on its small slice of retained earnings. After 10 years of this slow growth, the company's earnings per share might have grown from $10 to perhaps $11.50. Your initial investment, through reinvested dividends and modest capital appreciation, might have turned your $10,000 into maybe $22,000. Not a bad outcome. Now consider Growth Compounders Corp. In year 1, you receive no dividend. The company takes the full $10 of your earnings and reinvests it at 20%. This means that next year, its earning power will increase by $2, 20% of $10. So in year 2, it earns $12 per share. It retains all of that and reinvests it again at 20%. In year 3, its earnings grow by another $2.40, 20% of $12, to $14.40 per share. This process continues, with the earnings base growing larger each year and the 20% return being applied to that ever-increasing base. This is the magic of compounding in action, fueled by retained earnings. After 10 years, Through this exponential growth, the company's earnings per share will have exploded from $10 to over $61. Your initial $10,000 investment, tracking this explosion in intrinsic value, would be worth over $61,000. You have nearly 3 times the wealth of the dividend chaser, and you achieved it by understanding that the profits being reinvested on your behalf were just as real and ultimately far more powerful than the small dividend checks you chose to forego. The direct financial connection is undeniable. The focus on high dividends often leads to investing in businesses with poor reinvestment opportunities, resulting in linear, not exponential, portfolio growth. The look-through earnings approach, which values retained earnings as the investor's own capital, guides you toward businesses that are true compounding machines, capable of creating staggering long-term shareholder returns. The difference is not just a few percentage points. Over an investing lifetime, it is the difference between a comfortable retirement and generational wealth. Now that we understand the what and why of look-through earnings, we must master the how. We need to move from philosophy to practical financial analysis. This brings us to the crucial task of calculating your true economic ownership. It's a process that requires you to open up a company's annual report, but the math itself is surprisingly simple. The best way to understand this is through one of Buffett's most brilliant and illustrative investments, the Washington Post Company. In 1973, the stock market was in a funk. Fear was rampant. The Washington Post, despite its world-class newspaper and growing portfolio of other media assets, saw its stock price pummeled. The entire company had a market valuation of just $80 million. Warren Buffett, applying his look-through lens, saw this as an absurdity. He knew that the single television station the company owned in Miami was probably worth more than $80 million by itself. The market was essentially giving away the Washington Post newspaper, Newsweek magazine, and several other TV stations for free. He invested over $10 million, acquiring a substantial stake in the company. Now, here is where the look-through calculation becomes critical. The Washington Post at the time did not pay a large dividend. A dividend-focused investor would have overlooked it entirely. But Buffett wasn't interested in the dividend. He was interested in his share of the company's total earnings. He saw that the company, under the brilliant leadership of Katharine Graham, was a cash-generating machine. The newspaper had a virtual monopoly in its market, and it produced far more cash than it needed to maintain its operations. Katharine Graham was then taking these retained earnings and making incredibly shrewd capital allocation decisions. She was buying back the company's own undervalued stock, which directly increased Buffett's percentage ownership of the business without him having to spend another dime. She was also using the retained earnings to buy other media properties at attractive prices. Buffett, in his partnership letters, didn't talk about the dividends he was receiving from the Post. He talked about his share of the Post's total earnings. He would perform a simple calculation, just like the one we are about to learn. He would look at the Post's net income for the year. Let's say it was $20 million. He would then look at his percentage ownership of the company. Let's say he owned 10%. His look-through earnings for that year were simply 10% of $20 million, which is $2 million. He would then compare this to the dividends he received. If the Post paid him $200,000 in dividends, he knew that the company had retained and reinvested $1.8 million of his money on his behalf. He saw that Katharine Graham was a far better capital allocator than he could ever be with that money, especially after he paid taxes on it. He was happy to let her keep his money and compound it for him inside the company, tax-free. Over the next few decades, that $10 million investment turned into well over $1 billion. This legendary success was built on this simple yet profound calculation. It was built on ignoring the trivial dividend and focusing on the enormous, untaxed and brilliantly reinvested retained earnings. He wasn't just a stockholder. He was a silent partner with K. Graham, and by calculating his look-through earnings each year, he was keeping score in a game that Wall Street wasn't even watching. The reason most investors never perform this simple, powerful calculation comes down to a pair of deeply ingrained psychological hurdles: confirmation bias and the illusion of control. Confirmation bias is our tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs. Once an investor learns the basics, that you should look at the EPS and the PE ratio, they spend their time seeking out data that reinforces the importance of those metrics. They read analyst reports focused on EPS estimates. They watch financial news that trumpets EPS beats and misses. The entire information ecosystem around them confirms their initial belief that EPS is the number that matters. To calculate look-through earnings, you have to consciously decide to go against the grain. You have to seek out disconfirming evidence that the simple EPS number might be wrong. This requires intellectual effort and humility. It's much easier and more psychologically comfortable to stay within the warm, reassuring consensus that focuses on the easily digestible EPS figure. This is then magnified by the illusion of control. This bias describes our tendency to overestimate our ability to control events. The quarterly earnings cycle gives investors a powerful illusion of control. Because the EPS number is released on a predictable schedule and is easy to track, it feels like a controllable variable. Investors feel they can predict it, trade around it, and react to it. It provides a sense of agency, a feeling that they are actively managing their investments. The reality of look-through earnings is much less comfortable. It forces you to confront the fact that you, as a minority shareholder, do not control the capital allocation decisions. You have hired a management team to do that for you. The look-through earnings calculation is not a tool of control. It is a tool of measurement. It allows you to measure how well your hired managers are doing their job. Are they taking your retained earnings and creating more value, or are they squandering them on foolish acquisitions and low-return projects? This requires a shift from a trader mindset, which seeks control, to an owner mindset, which seeks understanding and evaluation. It's a surrender of the illusion of short-term control in exchange for the genuine, long-term power that comes from partnering with excellent capital allocators. Most people are unwilling to make this trade. They prefer the feeling of being in the driver's seat, even if they are just spinning the wheel while the car drives itself. The discipline of calculating look-through earnings is an admission that your job is not to steer the company day to day, but to choose the right driver in the first place, and then to monitor their performance using the correct metric. Not the flawed metric of reported EPS, but the true metric of long-term value creation fueled by retained earnings. Now let's turn this powerful theory into a precise, actionable blueprint. This is the look-through earnings calculator, a step-by-step model that will allow you to determine your true economic profit from any stock you own. You will need a pen and paper, or a simple spreadsheet, and access to a company's latest annual report, also known as a 10K, which is freely available on any financial website or the company's own investor relations page. Step 1. Identify your company and your ownership stake. Let's use a real-world example. Suppose you own 500 shares of Microsoft. The first thing you need to do is write that down. My shares, 500. Step 2. Find the company's total profit. Open the 10K report and find the Consolidated Statements of Operations, which is the formal name for the income statement. Look for the bottom line figure, which is usually labeled net income. For Microsoft's fiscal year 2023, their net income was approximately $72.7 billion. Write this down. Total net income, $72.7 billion. Step 3. Find the total number of shares. On that same income statement, usually just below the net income line, you will find the, quote, weighted average shares outstanding, diluted. This is the total number of shares the company uses to calculate its EPS. For Microsoft in 2023, this number was about 7.47 billion shares. Write this down. Total shares outstanding, 7.47 billion. Step 4. Calculate your percentage ownership. This is a crucial step that most investors never take. You are going to calculate what slice of this global giant you actually own. The formula is simple. Your shares divided by the total shares. In our example, it's 500 divided by 7.47 billion. This gives you a very small number, approximately 0.0000067%. While it may seem tiny, it is your precise, real ownership stake in the entire enterprise. Step 5. Calculate your look-through earnings. Now you will apply your ownership percentage to the company's total profit. The formula is net income multiplied by your percentage ownership. So, it's $72.7 billion multiplied by 0.0000067%. The result is approximately $4.870. This is the most important number in this entire process. For fiscal year 2023, your 500 shares of Microsoft generated $4.870 of real, economic profit for you. This was your share of the business's success. This is the entry in your business owner's ledger. Step 6. Compare your profit to your cash received. Now let's see how that profit was allocated. Find the company's dividend information. In fiscal year 2023, Microsoft paid a dividend of $2.72 per share. Since you own 500 shares, the total cash you received was 500 times $2.72, which is $1,360. This was your salary from the business. Step 7. Calculate the amount reinvested for you. This is the final eye-opening step. Subtract the cash you received from your total profit. That's $4.870 minus $1,360, which equals $3.510. This $3.510 is the amount of your profit that Microsoft's management, led by Satya Nadella, kept in the company to reinvest on your behalf. It's your money, working for you, funding research in artificial intelligence, building new data centers for their cloud business, and expanding their gaming division. Your real profit was not the $1,360 that hit your account. It was the full $4.870. By performing this 7-step calculation for every stock in your portfolio, you will have a radically clearer understanding of what you own and how your wealth is actually being generated. You are no longer just looking at a stock price. You are looking through to the economic engine you partly own. The antithesis to this diligent, ownership-focused approach is the analyst scorecard follower. This individual has completely outsourced their critical thinking to the machinery of Wall Street. Their investment process is not one of fundamental analysis, but of following the herd and chasing the pronouncements of so-called experts. The world of the analyst scorecard follower is dominated by 3 things: EPS estimates, price targets, and buy/sell/hold ratings. They see an analyst from a major investment bank appear on television, declaring a buy rating on a stock with a price target 30% higher than the current price. This provides a powerful jolt of social proof and authority. If this expert thinks it's a buy, they reason, who am I to argue? They don't do their own work. They don't open the 10K. They don't calculate their look-through earnings. They simply adopt the analyst's conclusion as their own. Their relationship with earnings is even more superficial than the EPS chasers. They don't even wait for the actual earnings to be released. They trade on the expectations for the earnings. They are playing a game of second-level thinking. What do I think the average analyst expects the earnings to be? This is a world of pure speculation, completely divorced from the underlying reality of the business. The disastrous consequences of this approach are on full display during earnings season. Let's say a company has been working for 3 years on a revolutionary new product. The research and development costs have been immense, which has depressed its reported EPS. The analysts, focused on the next 90 days, have set a low EPS estimate. The company finally launches the product, and it's a massive hit. But in that same quarter, the final launch costs were so high that the company's reported EPS comes in a few cents below the analyst estimate. The analyst scorecard follower sees only one thing: a miss. The herd of other followers sees the same thing. The algorithms designed to trade on these headlines fire off sell orders. The stock price plummets 15%. The follower, panicking, sells their shares, cursing the company for its bad quarter. They have just sold their stake in a business on the cusp of a decade of explosive growth, simply because a short-term accounting number failed to match an arbitrary prediction. The look-through earnings investor, in contrast, would see a completely different picture. They would see that the retained earnings were being invested brilliantly into a product that will generate enormous future profits. They would see the dip in the stock price not as a disaster, but as a golden opportunity to buy more of a great business at a discount, thanks to the market's short-sightedness. The analyst scorecard follower is perpetually caught in this web of short-term expectations. They are not investing in businesses. They are betting on whether a company can jump over an arbitrary bar set by someone else. This path is one of high anxiety, high trading costs, and ultimately, low returns. It is the complete surrender of individual judgment in favor of a consensus that is almost always focused on the wrong things. The direct financial connection of this approach is the ability to build a personal owner's balance sheet and owner's income statement for your investments. This translates the abstract concept of look-through earnings into a tangible framework for tracking your personal wealth creation. Let's go back to our Microsoft example. First, you create your owner's balance sheet for this specific holding. On one side, you have the market value of your asset. If Microsoft's stock price is, say, $350 per share, your 500 shares have a market value of $175,000. This is the number your brokerage statement shows you. It's what the market is willing to pay you today. But on the other side of your personal balance sheet, you list the intrinsic value of your asset. This is a bit more complex, but it's based on the underlying reality. You would start with your share of the company's book value, or its net assets. More importantly, you track the growth in this intrinsic value over time as a result of those retained earnings. Now, let's create your owner's income statement for the year from this investment. Your revenue for the year is not the dividend. Your revenue is your full look-through earnings, which we calculated to be $4.870. This is the total economic value that your piece of the business generated. Under expenses, you could list an opportunity cost expense if you like, what you could have earned with that money elsewhere. But for simplicity, let's focus on the profit. Your net profit for the year from your Microsoft business was $4.870. Of this profit, your cash distribution, your dividend, was $1.360, and your reinvestment by management was $3.510. This simple income statement completely reframes your understanding of your investment's performance. Your brokerage statement might show that the stock price went up by $10,000 this year, and you received $1.360 in dividends. It tells you times what happened, but your owner's income statement tells you times why. It shows that the business you partly own is a powerhouse of profitability, generating thousands of dollars in real economic value on your behalf, and that the majority of that value is being strategically reinvested to create even more value in the future. This approach has a direct and profound impact on your investment behavior. When the market panics and the stock price of Microsoft drops by 20%, the person who only looks at the market value feels a loss of $35,000. They might panic and sell. But you, with your owner's income statement, look at the situation differently. You ask, has the fundamental earning power of my business changed? Has its ability to generate that $4.870 a year on my behalf been impaired? If the answer is no, you realize that the market is simply offering you the chance to buy more of this incredible profit stream at a cheaper price. The stock price has become disconnected from the underlying economic reality. This quantified, business-like perspective is your shield against market volatility and your compass for long-term portfolio growth. It is the ultimate financial connection between the look-through concept and superior investment returns. With this ability to calculate our true earnings, we can now ascend to the next level of understanding. It's not enough to know that earnings are being retained. We must know how effectively they are being used. This is where we uncover the true magic of compounding. we must learn to see retained earnings as our silent partner, a portion of our own capital working tirelessly to build our wealth, day and night. The greatest case study for this principle is not an investment Buffett made, but the company he built, Berkshire Hathaway itself. Berkshire Hathaway is the ultimate look-through earnings machine. For over 50 years, the company has paid no dividend. Zero. A dividend chaser would look at Berkshire's stock and see absolutely nothing of value. Yet it has been one of the greatest wealth-creating enterprises in human history, turning early investors into multimillionaires and billionaires. How? By retaining 100% of its earnings and having the greatest capital allocator of all time, Warren Buffett, reinvest them. In his early letters to the shareholders of Berkshire Hathaway, Buffett laid out the logic with perfect clarity. He essentially made a pact with his investors. He told them, $1 of our earnings can be deployed in one of two ways. We can pay it out to you as a dividend. You will then have to pay income taxes on that dollar, leaving you with perhaps 70 cents. You can then take that 70 cents and invest it yourself. Or, we can keep that dollar inside the company. We at the corporate level will not pay tax on it. And I believe I can take that full dollar and reinvest it in businesses or stocks that will generate a much higher return than you could likely achieve on your own. He established a clear test. He would only retain $1 of earnings if he was reasonably certain that it would create more than $1 of long-term market value for his shareholders. This was his promise. For the next 5 decades, he made good on that promise in a way the world had never seen. The retained earnings from the original, struggling textile mill were first used to buy insurance companies like National Indemnity. These insurance companies generated huge amounts of float premiums that were collected up front and held before being paid out as claims. Buffett then took this float, along with the retained earnings from all of Berkshire's businesses, and used it as a massive, interest-free loan to buy other wonderful companies. He bought See's Candies, the Buffalo News, Nebraska Furniture Mart. He bought huge stakes in Coca-Cola, American Express, and the Washington Post. Each of these businesses in turn produced their own stream of earnings. The majority of those earnings were not paid out. They were sent back to Omaha, to Buffett, who would then reallocate them into the next great opportunity. Berkshire Hathaway became a magnificent financial flywheel. The retained earnings from dozens of businesses were continuously recycled and redeployed into new streams of income, which in turn generated more retained earnings. It was a compounding engine of unprecedented scale and efficiency, all fueled by the simple principle of retaining earnings and intelligently reinvesting them. The shareholders who understood this, who saw their retained earnings as a silent partner working for them under Buffett's genius, became fabulously wealthy. They didn't need a dividend check. Their reward was watching the intrinsic value of their single share of Berkshire Hathaway compound at over 20% annually for half a century, a financial miracle driven entirely by this powerful concept. The primary psychological force that prevents most people from embracing this powerful engine of compounding is a deep-seated cognitive bias known as hyperbolic discounting, more commonly called present bias. This is our brain's powerful and often irrational preference for smaller, immediate rewards over larger, delayed rewards. A famous experiment illustrates this perfectly. If you offer someone the choice between $100 today or $110 in a week, most people will choose the $100 today. They are willing to pay a steep price, an annualized interest rate of over 500%, for the comfort of immediate gratification. However, if you offer the same people the choice between $100 in 52 weeks or $110 in 53 weeks, almost everyone will choose the $110. In both cases, it's a choice between waiting one extra week for an extra $10. But when the reward is far in the future, our rational brain takes over. When the reward is immediate, our impulsive emotional brain hijacks the decision. This is precisely the psychological battle that plays out in the choice between dividends and retained earnings. A dividend is the $100 today. It's a tangible, immediate reward. It hits your brokerage account, you see the cash, You feel a sense of security and progress. Your present bias is satisfied. The growth in a company's intrinsic value from reinvested retained earnings is the $110 in a week, or more accurately, the $10,000 in a decade. It's a larger, more valuable reward, but it is delayed, abstract, and uncertain. To value it properly, you need to engage your logical, patient, forward-thinking brain. You have to override the powerful, primal urge for the immediate payout. The dividend chaser is a person who consistently gives in to their present bias. They will always choose the small, certain cash payment today over the potentially massive, but delayed, growth in business value tomorrow. They are neurologically wired to prefer the dividend. The entire concept of long-term investing and compounding is a war against hyperbolic discounting. It requires the mental fortitude to delay gratification on a grand scale. Buffett's philosophy of look-through earnings is the perfect intellectual weapon in this war. By forcing you to calculate your share of the retained earnings, it makes the abstract future reward more concrete. It allows you to see that the $3.510 reinvested by Microsoft on your behalf is not a nebulous concept. It is your specific property, a real asset that has been added to your personal wealth. You are framing the delayed reward in a way that makes it more psychologically salient. It helps you bridge the gap between your impulsive present self and your aspirational future self. Mastering this bias is non-negotiable for achieving significant portfolio growth. You must train your brain to derive more pleasure from seeing a company's return on equity and return on retained earnings than from seeing a small dividend payment show up in your account. You must learn to love the process of compounding itself, to see the beauty in a business that is intelligently deferring rewards for a greater future payoff. This is the psychological maturity that separates the amateur from the professional investor. To move from simply appreciating compounding to actively identifying the best compounding machines, we need a more advanced mental model. This is the reinvestment moat analysis. A company's competitive advantage, its moat, protects its current profits. But the reinvestment moat determines its ability to invest new capital at high rates of return, which is the key to future growth. This is a four-step process to evaluate how well a company is using your retained earnings. Step 1. Calculate the total retained earnings over a significant period, for instance, the last 5 or 10 years. You do this by going back through the annual reports. For each year, you take the net income and subtract the total dividends paid. Then you sum up these annual retained earnings figures for your chosen period. For example, if a company retained $1 billion a year for 5 years, its total retained earnings for the period is $5 billion. This figure represents the total amount of shareholder capital that management has been given to reinvest. Step 2. Calculate the growth in earnings over that same period. Look at the company's earnings per share, or net income from 5 years ago, and look at it today. Find the difference. For instance, if the company was earning $2 per share 5 years ago and is earning $5 per share today, the growth in earnings has been $3 per share. This growth is the Cranston's sire of the reinvestment. Step 3. Calculate the return on retained earnings. This is the crucial metric. You divide the growth in earnings from Step 2 by the total retained earnings from Step 1. To continue our per-share example, if the company retained a total of $15 per share over the 5 years to produce that $3 growth in annual earnings, its return on retained earnings is $3 divided by $15, which is 20%. This 20% is an incredibly powerful number. It tells you that for every dollar of your profit that management kept, they have successfully turned it into an asset that generates an additional 20 cents of profit for you every single year into perpetuity. This is the measure of management skill as capital allocators. Step 4. Establish a hurdle rate and compare. You need a benchmark to judge whether this return is good or not. Buffett has often used the historical return of the stock market, around 8 to 10%, as a bare minimum. A truly great business, a genuine compounding machine, should be able to consistently generate a return on its retained earnings of 15% or higher. When you find a company that shows a long history of retaining a significant portion of its earnings and generating high returns on that retained capital, you have likely found a powerful engine for wealth creation. This reinvestment moat analysis takes you far beyond the simple look-through calculation. You are no longer just asking, how much of my money did they keep? You are now asking the far more sophisticated question, how skillfully did they invest my money? This analysis allows you to separate the truly great businesses, which can reinvest capital at high rates, from the mediocre ones that are simply growing for the sake of growing. It is the key to identifying the quiet compounders that will build the bulk of your long-term wealth. The path of the 99% in this domain leads to a different kind of trap, the growth at any price gambler. This investor is the mirror image of the dividend chaser. While the dividend chaser is obsessed with the earnings paid out, the growth gambler is mesmerized by the idea of growth itself, without ever questioning its quality or its cost. This investor sees a company that retains 100% of its earnings and automatically assumes it must be a fantastic investment. They hear a story about a revolutionary new technology or a rapidly expanding market, and they get excited. They see revenue growing at 50% a year and they pile in, buying the stock at an exorbitant valuation. They are buying the sizzle, not the steak. What the growth at any price gambler fails to do is the reinvestment moat analysis. They don't check to see if the growth is actually profitable or if it is creating shareholder value. They might be buying into a company that is retaining all of its earnings, or more commonly, burning through cash from investors and pouring it into projects that generate terrible returns. This is what Buffett's partner, Charlie Munger, famously calls diversification. A company's management team, flush with cash and ego, decides to expand into an area they know nothing about. They make a massive acquisition, paying a huge premium for another company. On paper, their empire is now bigger, their revenues have grown. But they have taken $1 of your retained earnings and invested it in an asset that will only ever generate 5 cents of future profit. They have destroyed value. Yet the growth at any price gambler, seeing the headline of the big acquisition, gets even more excited and buys more stock. They are cheering for a management team that is actively lighting their money on fire. They are confusing activity with progress, size with value. They fall in love with a compelling narrative and ignore the brutal mathematics of capital allocation. This strategy often works for short periods, especially during speculative market bubbles. The story stocks can fly high, propelled by nothing more than hype. But eventually, reality always asserts itself. A business that cannot generate a respectable return on the capital it invests is ultimately worthless. When the story fades and the market demands to see actual, sustainable profits, these stocks collapse. The growth at any price gambler is left holding the bag, having paid a premium price for a business that excels at destroying capital. This is a more seductive and perhaps even more dangerous path than that of the dividend chaser. It preys on our optimism, our love of innovation, and our desire to be part of the next big thing. But without the grounding discipline of analyzing the return on retained capital, it is a speculative gamble, not a sound investment strategy. The long-term financial difference between investing in a true compounding machine and a growth-at-any-price capital destroyer is not just significant, it is astronomical. Let's create a tale of two compounding journeys over a 20-year period to illustrate this stark reality. Both companies, let's call them Capital Creators Inc. and Empire Builders Limited, start at the same place. Each has a book value of $1 billion and earns $100 million a year, a 10% return on equity. Both companies decide to retain all of their earnings to fund growth. The growth at any price gambler would see both as exciting growth stocks. But now, we apply our reinvestment moat analysis. Capital Creators Inc. has a deep moat and excellent management. It is able to take its $100 million in retained earnings and reinvest it at a superb 20% rate of return. Empire Builders Limited, on the other hand, is in a fiercely competitive industry and has a management team focused on size, not profitability. It takes its $100 million in retained earnings and reinvests it in marginal projects and overpriced acquisitions that only generate a 5% rate of return. Let's watch what happens over 20 years. In year 2, Capital Creators takes its $100 million of retained earnings, invests it at 20%, and adds $20 million to its annual earning power. Its earnings are now $120 million. Its book value has grown to $1.1 billion. Empire Builders takes its $100 million, invests it at 5%, and adds only $5 million to its annual earning power. Its earnings are now $105 million. Now let's let the compounding engine run. Capital Creators continues to retain all its earnings and reinvest them at 20%. Empire Builders continues to retain all its earnings and reinvest them at 5%. The gap between them starts small, but widens exponentially. After 10 years, Capital Creators Inc. will be earning over $600 million a year. Its business value will have multiplied many times over. Empire Builders Limited, after 10 years of retaining and reinvesting every penny, will only be earning about $160 million a year. It has grown, but feebly. Now let's go out to 20 years. After 2 decades of this process, Capital Creators Inc., the business with the high return on retained capital, will have an annual earning power of over $3.8 billion. Its intrinsic value will have grown by a factor of more than 38. Empire Builders Limited, the business with the low return on capital, will have an annual earning power of just $265 million. It has not even tripled its earnings despite retaining 2 decades worth of profits. An initial investment of $10,000 in Capital Creators would have become a fortune. A similar investment in Empire Builders would have been a colossal disappointment, likely failing to even keep pace with a simple index fund. This is the direct, quantifiable, and brutal financial connection. It demonstrates that the single most important determinant of a company's long-term success is not how much it grows, but the rate of return it earns on the capital it reinvests. Understanding this, and using the look-through earnings concept to track it, is the master key to long-term investing and superior portfolio growth. We have now arrived at the final and most crucial pillar of this philosophy, using this knowledge to exploit the market's blind spots. The ultimate goal is not just to understand a business, but to buy it at an attractive price. The very structure of the market, its obsession with reported EPS, and its inherent short-termism, creates wonderful opportunities for the investor who has mastered the look-through earnings perspective. You can identify and purchase quiet compounders at prices that do not reflect their true, long-term value creation potential. The perfect historical anecdote for this is Warren Buffett's investment in the Coca-Cola Company in 1988. Following the market crash of 1987, investor sentiment was bleak. Coca-Cola was seen by many on Wall Street as a mature, even boring company. Its glory days of rapid growth were thought to be over. It was a massive, blue-chip stock, and its dividend was decent, but not spectacular. The consensus was that it was a solid but unexciting hold. But Buffett, applying his look-through lens, saw a completely different reality. He didn't see a slow-growth utility. He saw one of the greatest businesses on earth being sold at a reasonable price. First, he looked through the balance sheet. He saw that Coca-Cola was a capital-light business. It didn't need to retain huge amounts of earnings to build factories. Its main assets were its secret formula and its brand name, which didn't appear on the balance sheet at all. This meant the business gushed free cash flow. Second, he looked at what the company's management, led by the legendary Roberto Goizueta, was doing with that cash flow. They were paying a dividend, yes, but more importantly, they were using a huge portion of the retained earnings to aggressively buy back the company's own shares. Buffett understood that a share buyback is a tax-efficient way of delivering value to shareholders. When a company buys back its own stock, it reduces the number of shares outstanding. This means that each remaining share represents a larger percentage ownership of the business. It's a way of using retained earnings to directly increase your stake in the company without you having to do a thing. Third, he looked at the global picture. He saw that while Coke was mature in the US, its international growth potential was still enormous. The capital being retained was being used to open up new markets all over the world, markets where Coke could establish a dominant position and earn incredibly high returns on that invested capital. The market, fixated on the next quarter's earnings in the United States, was almost completely ignoring this massive, long-term compounding engine firing up overseas. Putting it all together, Buffett saw a business that the market was mispricing. The reported EPS number did not capture the explosive growth in intrinsic value per share that was being created by the combination of share buybacks and high-return global expansion, all funded by retained earnings. He saw a quiet compounder hiding in plain sight. In 1_988, he invested over $1 billion, about a quarter of Berkshire's entire portfolio at the time, into Coca-Cola stock. Over the next decade, the market woke up to the reality that Buffett had seen years earlier. The stock price soared, multiplying over 10 times and turning his billion-dollar investment into one of the cornerstones of the Berkshire Hathaway empire. This was possible only because he ignored the market's short-sighted narrative and used the look-through framework to see the true economic engine at work. The market's persistent failure to properly value quiet compounders like Coca-Cola in 1988 is not an accident. It is the direct result of powerful psychological and structural forces. The two primary drivers are herd behavior and the pervasive disease of short-termism. Herd behavior is the tendency for individuals to mimic the actions of a larger group, whether those actions are rational or not. In the investing world, the herd is the collective consensus of Wall Street analysts, fund managers, and the financial media. This herd is overwhelmingly focused on short-term performance. Why? Because of the institutional imperative. A professional fund manager's job performance is typically reviewed on a quarterly or annual basis. They cannot afford to underperform their peers or their benchmark for very long, or they will lose assets, and eventually, their job. This creates a powerful incentive to think like everyone else and to own the same popular stocks. Imagine a fund manager in 1988 who decides to make a huge bet on boring Coca-Cola. Meanwhile, her competitors are all invested in some hot technology trend. If the tech trend continues to soar for another year and Coke's stock stays flat, that fund manager will look foolish. She will have to answer difficult questions from her clients and her boss. It is far safer from a career perspective to be conventionally wrong than to be unconventionally right. The safe bet is to join the herd. This herd, due to its need for short-term validation, naturally gravitates towards companies that can reliably meet or beat quarterly EPS estimates. This creates a huge blind spot. The herd systematically overlooks or even punishes companies that are making intelligent long-term investments at the expense of short-term reported profits. A company that spends heavily on R&D, a company that enters a new market and will incur losses for a few years before turning a profit, or a company that is methodically buying back its stock instead of chasing headline-grabbing acquisitions will often be ignored or sold by the herd. This is the opportunity for the look-through investor. You can operate on a different time scale. You don't have a boss to report to every quarter. You can afford to be patient. While the herd is chasing the stocks that are making the most noise right now, you can be quietly accumulating shares in the businesses that are creating the most value for the long term. You are essentially exploiting a market inefficiency created by the flawed incentive structures of the professional investment world. You are taking the other side of the short-termism trade. The herd's need for immediate gratification creates the very discounts that allow the patient, long-term investor to achieve extraordinary results. By adopting the look-through perspective, you are not just using a better analytical tool, you are stepping outside of the psychological and institutional framework that traps the 99% in a cycle of short-term thinking. To systematically uncover these opportunities, you need a final blueprint, a practical checklist. We'll call it the mispricing scanner. This is a 5-step process for actively hunting for the quiet compounders that the market overlooks. Step 1. Screen for a disconnect between profitability and valuation. Use a stock screener to look for companies with a consistently high return on equity, ROE, say above 15% for the last 5 years, but that are trading at a moderate or low price-to-earnings PE ratio. A high ROE is a sign of a profitable, high-quality business. A low PE ratio is a sign that the market is not particularly excited about it. This combination is often the first clue that you've found a profitable company that the herd is ignoring. Step 2. Specifically hunt for low-dividend, high-reinvestment quality companies. Add another filter to your screen. Look for companies with a low dividend payout ratio, for example, under 30%. Then, for the companies that pass this screen, you must do the reinvestment mode analysis we discussed earlier. Calculate their return on retained earnings. You are looking for the holy grail, a company with a high ROE, a low PE, a low dividend payout, and a high return on retained earnings. This is the statistical signature of a potential quiet compounder. Step 3. Read the CEO's letter to shareholders. This is a crucial qualitative check. Find the last few annual reports and read the chairman's or CEO's letter at the beginning. What is the language they use? Are they obsessed with the stock price and hitting quarterly analyst estimates? Or do they write like a business owner talking to their partners? Do they discuss concepts like intrinsic value, return on invested capital, and long-term strategy? The words they choose reveal their mindset. You want to partner with managers who think like you, who see themselves as stewards of your capital for the long haul. Step 4. Look for intelligent share buybacks. Check the company's cash flow statements for the last few years. Look for a line item called repurchase of common stock. Is the company consistently buying back its own shares? Now compare this activity to a chart of the stock price. Is the company buying back more stock when the price is low? This is a powerful sign of a shareholder-friendly management team that understands capital allocation. They are using your retained earnings to buy more of their own great business when the market is offering it at a discount. This is a huge creator of long-term value. Step 5. Assess the durability of the moat. Once you've found a candidate that passes all these checks, the final question is, how sustainable is its success? What is its competitive advantage? Is it a strong brand, a network effect, a low-cost production process, a patent? How likely is it that this company will still be earning high returns on capital 10 or 20 years from now? This is the final, forward-looking piece of the puzzle. By running this 5-step mispricing scanner, you are turning the tables on the market. You are using its own short-sightedness as your primary tool for discovery. You are looking for the exact combination of financial and qualitative characteristics that the herd tends to ignore, but that are the fundamental drivers of all great long-term investments. This is the essence of advanced investing. To fully grasp the magnitude of this advantage, we must contrast it with the final, and perhaps most common, path of the 99%, the story stock speculator. This individual represents the final abandonment of financial analysis altogether. They are not guided by reported earnings, and they are certainly not guided by look-through earnings. They are guided by pure narrative. The story stock speculator buys into a company not because of its proven profitability or its sound balance sheet, but because it has a compelling story. It might be a company in a hot new industry, like electric vehicles, artificial intelligence, or genomics. The CEO is often a charismatic visionary who gives captivating interviews. The story is always about a massive, world-changing future. The problem is, the business itself has no profits. It is often losing hundreds of millions or even billions of dollars a year. It has no earnings, reported or otherwise, to analyze. The investment is a pure bet on the story coming true one day. It is the purchase of a lottery ticket, not a piece of a business. The speculator rationalizes this by saying, "This is the next Amazon. Amazon lost money for years." They are correct that some story stocks do, against all odds, eventually become wildly successful. But they forget the thousands of other story stocks from the dot-com bubble and other speculative manias that went to zero. They are suffering from survivorship bias, focusing only on the rare winners while ignoring the graveyard of losers. The mindset of the story stock speculator is the polar opposite of the look-through investor. The look-through investor's approach is grounded in the present reality of a business's proven ability to generate cash profit. Their projections of the future are based on the mathematical reality of what the company can earn on its reinvested capital. The story stock speculator's approach is completely unmoored from present reality. It is a bet on a future that may or may not materialize. It is based on hope, while value investing is based on evidence. While speculation can be thrilling and can occasionally produce a spectacular win, it is a low-probability, low-consistency strategy for building long-term wealth. It is the path of the gambler, not the proprietor. The discipline of look-through earnings is the ultimate anchor to reality. It forces you to invest only in businesses that are already successful, already profitable, and are using those profits to intelligently build an even more valuable enterprise. It protects you from the siren song of captivating stories that have no economic substance. Let's conclude by forging a final, powerful tool that quantifies the entire thesis of this discussion. We can call it the look-through PE ratio. This is a conceptual metric that adjusts the standard price-to-earnings ratio to account for the value created by retained earnings. The standard PE ratio, as we know, is simply the stock's current price divided by its reported earnings per share. A company might look expensive with a PE of 30. But what if that company is a masterful capital allocator? Let's take a company that has a stock price of $300 and reported EPS of $10. Its PE ratio is 30. A conventional investor might dismiss it as too expensive. Now let's apply the look-through lens. The company pays no dividend. It retains 100% of its earnings, the full $10 per share. We do our reinvestment moat analysis and find that this company consistently earns a phenomenal 25% return on its retained capital. This is where the look-through PE comes in. That $10 of retained earnings is not just $10, it is a seed that has been planted. Because the company can earn 25% on it, that $10 will generate an extra $2.50 of earnings for you next year, and the year after, and every year into the future. That $10 of retained earnings has created a perpetual stream of future profits. What is the present value of that perpetual stream? Using a simple perpetuity formula from finance, cash flow/discount rate, and assuming a 10% discount rate for future earnings, the present value of that $2.50 annual stream is $2.50 divided by 0.10, which is $25. So the economic value created this year was not just the $10 of reported earnings. It was the $10 in cash profit plus the $25 in present value of the future profits it will generate. The total economic value created per share was $35. Now, let's calculate our look-through PE ratio. We take the stock price, $300, and divide it not by the reported earnings of $10, but by our calculated total economic value of $35. The result is a PE ratio of approximately 8.6. Suddenly, the company that looked expensive at 30 times reported earnings looks incredibly cheap at under 9 times its true economic earnings. This single powerful calculation encapsulates the entire philosophy. It financially demonstrates why a company that can reinvest its retained earnings at a high rate of return is vastly more valuable than a company that can't. It gives you a concrete, quantitative tool for beating the market by identifying companies whose stock price reflects their simple reported earnings, but not the enormous hidden value they are creating through intelligent capital allocation. This is the final key. It is the culmination of our journey from deconstructing a flawed metric to building a comprehensive framework for seeing and valuing a business as a true owner. You have made a significant investment of your time and focus, and in return, you have acquired a powerful new lens through which to view the entire world of finance. You no longer just see a stock ticker and a price. You see a claim on a living, breathing business. You have acquired the mental model of look-through earnings, a tool of profound financial analysis that separates the world's most successful investors from the reactive crowd. You can now calculate your true share of a company's profits, judge the skill of its management, and identify the powerful compounding machines that quietly build fortunes. This is a formidable advantage. But understanding a company's true earnings is only the first half of the equation. Warren Buffett pairs this analysis with another, equally powerful mental model for determining the capital price he is willing to pay for those earnings. Knowing what a business is truly earning is one thing, knowing its ultimate worth is another. It is the crucial link between brilliant analysis and profitable action, the bridge between identifying a great business and buying it at a great price. The algorithm is now presenting you with a video on your screen. Think of it not as a random suggestion, but as the next logical step in this journey of investor education. It holds the potential key to bridging that gap, the missing link that connects the calculation of true profit to the discipline of value investing and determining intrinsic value. The casual viewer stops here, content with one new idea, believing their work is done. But you are not a casual viewer. You are an architect of your own financial freedom, an assembler of a complete mental toolkit. The decision to click is not about watching another video. It is a conscious choice to continue your ascent from amateur speculator to sophisticated capital allocator. The next piece of the map awaits.